Canada's collapse has begun. I'm Steve Van Metre. Trade war fears are crushing Canada's economy, causing central bankers and political elites to panic. It's spreading fast, indicating the entire global economy is about to plunge into stagflation. Now let's head over to Bloomberg, where he picked today's story up with a headline: Is Bank of Canada sees year-long recession and all-out trade war. And what the Bank of Canada is admitting is their economy is too dependent on the United States for trade, meaning without trade, their economy is now likely to plunge into recession. Until it's resolved, it could go as long for a year or more, indicating, as we're about to find out, Canada is facing a nightmare of an economic scenario, and that's called stagflation. But what happens in the Canadian economy and inflation depends critically on U.S. trade policy, which remains highly unpredictable. This according to Bank of Canada Governor Tiff Macklem. And this is exactly what President Donald Trump wanted. This is a game of economic chicken. Whose economy is the strongest? Remember, he said there would be a period of pain and adjustment to meet his objectives. And what we're finding out is that Canada's economy is now starting to experience an immense amount of pain, one that's panicking central bankers and political elites alike because they're so dependent on us. Until this trade war is resolved, the experts are now saying it's a foregone conclusion that Canada heads right into a recession. And given this uncertainty, forecasts for economic growth and inflation are of little use as a guide to anything, because nobody knows when the trade war is going to end or what the end result will be. And that's a problem, because monetary policy can't save Canada's economy. But let's take a look at how they're headed right into stagflation. But if you think the United States is immune to this, well, hang tight. I'm going to show you we're not immune at all. Let's take a look at some U.S. data here and see what's happening in Canada. Is the expectation is inflation is likely to rise as we look at the consumer price index in blue. And we already heard from Tiff Macklem that the real gross domestic product likely to continue to the downside and contract as long as the trade war persists. And when you get that combination of slowing growth and rising inflation, it's called stagflation. Now we can look and see in the U.S., stagflation pushed us right into the 91 recession, the dot-com bubble, the global financial crisis, and it's setting us up for that as well. But the issue here is whose economy is the strongest, because that is the objective. If everyone else falls first, they'll come to the negotiating table and quick. But even in this scenario where most tariffs are scrapped, the process is unpredictable and businesses and households remain cautious. The uncertainty around trade policy weighs on activity, and that is one of the big issues that we're going to face all over the world. Even here at home in the United States, is uncertainty is going to cause a lot of business executives to freeze decisions. Consumers are going to start tightening their belt, saving more, paying down their debt, spending less. And this is all going to backfeed into the economy. And we've talked about how there's going to be a payback period from the pandemic and then the front running of the tariffs. And now with all this uncertainty, it's setting up for a very long adjustment period, one that could see the entire global economy right into stagflation. And as a result, gross domestic product growth stalls in the second quarter, with exports falling sharply and business investment contracting. Consumption is subdued in the near term as households build up precautionary savings due to concerns about future employment prospects and wealth. And that puts Canada's economy right into the worst possible scenario. It tells us we're headed right into stagflation, and where they go, the rest of the world is going to follow, because other countries, while they may not be as dependent on trade with us for their economic growth, they still are dependent. And here we can see what is likely coming for Canadian consumers and consumers all over the world as we take a look at continued unemployment claims in blue against the personal savings rate in red. And what we can see is Governor Tiff Macklem saying, look, there's going to be uncertainty about people's finances and jobs, meaning there's going to be rising unemployment as we see here in blue. At the same time, when that starts to happen and consumers lose confidence in the labor market, they start to save more. You see the personal savings rate rise, and what that means is less money spent in the retail sales side of the economy, right into, again, the 91 recession, the dot-com bubble, the global financial crisis. We saw it starting to happen going into the pandemic, and we're seeing even the early signs of it happen here in the United States. So in a game of economic chicken, of whose economy remains the strongest, right now, Canada is panicking, thinking that if this isn't resolved and fast, they're headed into a recession, one that could send their entire economy plunging right into stagflation. In the second scenario, the central bank assumes the imposition of U.S. tariffs, including a whopping 25% levies on motor vehicle and parts, with Canada's associated retaliation, but that changed today. It sees Trump adding 12% tariff on many Mexican and Canadian goods, and this scenario pitches the globe, not just Canada, not just the United States, the entire global economy into a long-lasting trade war, and the economic consequences are severe. Canada's GDP contracts in the second quarter, and the economy spends a year in what the bank called a significant recession, which permanently lowers the standard of living in the country. But it won't be just Canada that sees a permanent decline in their standard of living. It's going to be consumers all over the world. And I want to know what you think. If this trade war goes on for an extended period, do you think your finances are going to be better off or worse off? Because they could be better off if you joined our momentum traders. Let's take a look at this trade on GDXJ that we put on the board back on the 10th. 4 days later, stopped out. We told our subscribers over the weekend to raise their stop loss levels. They made a quick 7.9% gain. And here's the best part. We're already on to our next big trades, and you can join us too. Grab the links in the description below. Use a coupon code for your free 30-day free trial. Stay tuned to the end of the show for more information. Officials led by Governor Tip Macklin kept policy rate at 2.75% on Wednesday, the first pause in 8 meetings. And here's the reason they did it: because monetary policy is ineffective during these times. Even if the trade war persists, they could lower rates all they want. But what they're admitting is the Canadian economy, far too dependent on the United States for trade, for its economic prosperity, and now central bankers are going on pause here because they can't do anything. As we consider monetary policy, we use these two scenarios to reflect uncertainty about U.S. trade. What happens with inflation will depend on what happens with tariffs, as monetary policy will ensure inflation remains well controlled and support economic growth as Canada confronts this unwanted trade war. But there's a problem, because what do tariffs tend to do to prices? It causes them to go up. Now, we already know the solution for higher prices is, in fact, higher prices when consumers can't afford them. But the problem here is central bankers think that they have to do something by keeping interest rates artificially high or even potentially raising them. So you have a double-edged problem here. Prices are going to go up due to the tariffs. Consumers already can't afford them, and central bankers are going to make it even more difficult to access credit and keep consumers paying high interest costs rather than cutting rates. It's a problem because what it means is central bankers are right in line with sending not just the Canadian economy, but economies all over the world right into a recession. Let's talk about why cutting rates doesn't have any effect, despite the fact that central bankers claim it does. Let's take a look at the unemployment rate in blue against the federal funds rate in red. And we go back to the late 1980s, heading into the 91 recession, and what happened? Continued claims started to bottom out. The Fed cut rates. It didn't make a difference. Then continued claims surged higher, and the Fed aggressively cut rates, going from nearly 15% all the way down to almost 6.5%. What happened? It did nothing. And there's a very simple reason why. People that don't have a job can't get loans. Banks don't lend to them. And now you can see why the Bank of Canada is on pause and why other central bankers are doing nothing as well, because they know they're powerless to stop what's happening and what's coming. You can see going into the dot-com bubble, unemployment rate rose, the Fed cut rates, and again, didn't stop the recession from happening, didn't stop the global financial crisis, and it's unlikely to stop the trend now. The Fed did cut rates, but we saw some front running into the tariffs that is definitely helping employment and production here in the United States, but that's not going to last a whole lot longer, because if you think what's happening in Canada is isolated to them, it's not. It's going to happen to economies all over the world. It's going to happen right here at home. But let's talk about why central bankers and political elites are panicking as Canadian Autotown gets an early taste of Trump's trade war. And again, this is exactly what President Trump wanted. He wanted other economies to experience pain before we did. The uncertainty of this is killer. The overall fear is we see widespread closures, referring to factories, because people aren't buying these vehicles. And that cascades throughout the system, through the automakers, down to the parts makers, and all the way down to the workers at Tim Hortons, where there won't be as many employees pouring coffee. And that's exactly the issue that I've made here, that when you see slowdowns in economic growth, it doesn't just impact one part of the supply chain. Yes, we know it impacts the manufacturing level, but it goes down to the suppliers and then everyone else. Because remember, manufacturers, they spend about 70% of the services sector revenue. So without manufacturing, well, services sector takes a hit, which is exactly why we see services follow manufacturing into a downturn. So this is a huge problem, and exactly why this next headline hit today. As Carney capitulates, as Canada waives retaliatory tariffs on U.S.-made cars and trucks as they face the reality as their economy is indeed heading into a recession, and as long as this trade war persists and as long as these tariffs stay up, it's going to only push Canada's economy into a massive stagflationary recession. Canadian Prime Minister Mark Carney says government will allow automakers to import U.S. manufactured cars and trucks without tariffs as long as the companies continue to build cars in Canada and continue with previously announced expansions, which of course they will all vow to do. After all, there was no downside to a promise, meaning Canada just conceded to a key Trump demand. And this is after Carney put retaliatory tariffs as much as 25% on vehicles made in the U.S. But there was another reason. It may have to do with Honda. As a winning blow in this particular trade war battle came from Japanese media outlet Nikkei, which reported that Honda Motor is looking at shifting some of its auto production from Canada and Mexico into the United States. Again, this is exactly what President Trump wanted, with the goal of having 90% of his vehicle sales produced locally. And all that did was cause panic, because if Canada and Mexico lose production of autos, well, it means they're going to lose jobs. So you can see why Carney panicked here and pulled off those retaliatory tariffs. But across the border, things here at home aren't looking that good, as we see New York business leaders say economic outlook is now worse than Lehman. The drastically decoupled trend of hard data improvement and soft data dissolution continued this morning, with U.S. manufacturing improving while the New York Fed business leader survey collapsing. And this is important. I said yesterday, just because in the short run you can see some good economic data, you can see some optimism, it's all about the future. And right now, leaders in New York are saying the future is bleak. The business climate was much worse than normal, and firms were the most pessimistic they've been about the outlook since 2020. Now think back, what happened in 2020? We had the pandemic, and this is how bad that payback period is looking. Again, we talked about this before. There's a payback for pulling demand forward during the pandemic, all of course due to the tariffs, and now due to uncertainty, and business leaders are saying it's going to be devastating. Of course, a lot of people lost their jobs, saw their hours cut, and their take-home pay shrink during that time. The survey's headline business activity index came in at minus 19.8, the lowest level in more than a year, with the 6-month forward expectations plunging to the weakest since COVID. And remember, when business owners are facing declining demand, they're going to cut hours, they're going to cut jobs. They have absolutely no choice. The business climate index dropped 9 points to minus 50, the lowest since Lehman, as expectations for prices paid soared into the top of 3-year highs. So we talked about how Canada is facing stagflation. Well, other economies are going to face it as well. They're just going to face it with a lag. And here you can see, according to these New York business leaders, the U.S. economy is facing that as well, as they say, look, business climate here is plunging to back where it was during COVID and the financial crisis. At the same time, prices are surging. That's the exact recipe of stagflation, and we know the odds of a recession happening in the United States under those conditions get somewhere very close to 100%. But we can see the manufacturing issues aren't just limited to Canada and the United States, as ASML warnings spurred global tech stock rout today. AMSL later added to investor anxiety by posting orders that missed expectations and saying it doesn't know how to quantify the impact of recent tariff announcements. And we're going to see this from a lot of other companies, because while ASML delivered on the revenue front, it's left investors disappointed at a time when uncertainty will punish such results. All of this just adds to the multitude of headaches facing tech CEOs right now, with no sign of the difficulty ending soon. And what investors want is an outlook where things are going. And I've said this before, companies are going to pull their projections because they have absolutely no clue. And this could be a catalyst to send stocks plunging. It's happening today. It could extend into the weeks that come. But I want to know what you think. Is the stock market just in a temporary problems place right now and about to turn around? Or do you think it's about to plunge even lower? Weigh in the comments. Love to hear from you. A bigger than expected drop in ASML bookings failed to alleviate concerns over a potential slowdown in AI demand. And this is something I've warned about, is that at some point this AI bubble is likely to burst, because companies have been spending hundreds of millions of dollars buying chips trying to win the AI race. But what's one of the problems? Consumers, they aren't really adopting it. And even worse, they're not really spending money to use it. So at some point, all these tech companies have to justify their spend during their future earnings. In a matter of a quarter or two, we could see some devastating results, and of course the market react with their stock price plunging. But what ASML is saying, look, orders are down. If that happens, well, what it's saying is a lot of these tech companies are already admitting that the AI bubble is about to burst. And what we can see in U.S. factory output as it increased at a modest pace at the head of tariffs. While it's good news for the U.S., there was some bad news in the report. The Fed's report showed capacity utilization at factories, a measure of potential output being used, edged up to 77.3%, but the overall industrial utilization rate dropped to 77.8%. So even during a period where we're seeing the tariffs being front run, the capacity utilization of factories didn't jump a whole lot. In fact, it even came down, and this is a major problem for U.S. workers. Other manufacturing reports are showing weakness in the sector as U.S. factory activity contracted, according to the ISM data earlier this month, and prices accelerated sharply amid expectations for slower economic growth, indicating from the U.S. manufacturing sector, just like what we're seeing in Canada and other parts of the world, is we're all headed right into stagflation. The problem for that is, well, it means a lot of workers are going to be on the unemployment line, which is exactly why Carney capitulated today. They're afraid of what's coming. Let's take a look at some U.S. data. We have the unemployment rate in blue and capacity utilization rate in red, and you can see a near mirror relationship to this. As capacity utilization decreases, what happens is factories cut hours, then they cut jobs, and because those workers can't transition to another job, they get stuck on unemployment. It backfeeds across the economy and the supply chain, and that took us right into the 91 recession. You can see the same thing happen going to the dot-com bubble. Capacity utilization fell, the unemployment rate rose. Happened again going into the global financial crisis, and we're seeing the early effects of it, except this bump here due to front running the tariffs. But what we're seeing in Canada is likely to happen here in the U.S. We're going to see capacity utilization flip to the downside, particularly as we know from New York business leaders. They're saying, look, their outlook is the worst since the financial crisis, since the COVID lows. And what this is telling us is that workers all across the world are going to be on the unemployment line, and one economy after the next is going to fall right into stagflation. But this doesn't mean you can't profit on the economic downturn. Just take a look at this trade on GDXJ, that's junior miners. And again, we made a quick 7.9% gain off a trade that was on the books for 4 days. And we were stopped out on the 14th and now looking to move that into our next big trade. Now, how do we do this? Each and every day, we look at momentum indicators across the broad equity, bond, currency, and commodity markets, and we aggregate them together. But something we found out is that momentum indicators, when price is going down, well, you can go from oversold to oversold to oversold, and if you try to buy them, you're just going to lose money. So what we did is we paired this with the trend, and now all of a sudden, with a rising trend and momentum turning the upside, we've got some amazing trades. Now, every day you get the daily report. You get all the tradable signals. I review the trades and give you my opinions on the best ones to take. We've integrated all of this data right into our modeling. You get risk control levels, a full tracking of all open trades and returns, a weekly update, and the best part is you can get your first 30 days on me. That's right. Grab the links in the description below. Use the coupon code. And the reason we do that is we're so confident you can make money trading our report. We want your first 30 days to be on me. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.